Hi everyone. Today I want to start by asking a simple question. If you have $200,000 sitting in a non registered account, did it end up there deliberately or you just never thought about it? Because the difference that I'm going to tell you is probably going to shock you, specifically Henrys of the world. Here's how it goes. If you do have $200,000 sitting in a non registered account, that is, not a TFSA, not an RRSP, not an FHSA, just non registered regular account, no limits, right? You are probably handing over 4.7K every year to the CRA, just like that. Now you might think, okay, yeah, that's a amount, but I'm Henry, I can deal with this, right? Not a problem. Well, here's a shocking twist. In 15 years, you will be handing CRA roughly around $47,000. Take a moment to realize it. You just handed over $47,000 to CRA that you didn't have to, and you never got to reinvest it for your own future Henry, right? Now I think you're listening, paying attention, right? Oh, $47,000. This is just a rough math, right? If you actually do the math, it'll probably be much higher than this. It's just my rough estimate. And the worst part is, it didn't have to be that way. You didn't require new strategies, you didn't require new money. You just required to move your particular account, the asset that you have, in a different account. And that's it. Simple as that. That one decision will have saved you thousands of dollars every year. And that is today's show. We're going to find out and see what exactly we need to do to solve this problem. And let's see what today's episode is all about. Here we go. The $47,000 mistakes. Most 200K earners never see it coming. So, as we discussed in our intro, today's topic is this: we are giving away 47K to CRA, which you don't have to, but we are just giving it away because we think it's just part of doing business. Now, why is that, you might ask? This is because your non registered account or non reg is working against you, not for you, against you. And this is another part: 53 cents lost on every dollar. Again, 53 cents lost on every dollar is compounding, literally working against you. And the fix is just one simple rebalance. If you want to know, stick around and figure out what those mistakes are and how we can avoid it if you are currently doing it or have thought about doing it. Let's see what they are. You might something coming up here in the slides, which is called, you're not putting the wrong money away, you're putting in the wrong place. Simple example of moving your money into a different account to help reduce taxes and take advantage of the current account that you have. And this is, as you might have guessed, is our core problem for today. So the issue I see with most of the Henrys are they will have an account, but we are all told the same stories by the same matrix. Oh, always fill out TFSA, always fill out RSP. Then whatever is left, you just put a non-registered account, right? Simple, because they know their option. But Henrys of the world, you are not a regular individual. Remember, the average Canadian salary might be around 50, 60, or 70K, but you guys are earning 180K or above that. So you already are facing higher income taxes. Now, on top of that, you want to pay more taxes to the government? Like, what is left for you then? That's why we see a lot of probably Canadians that you might have heard leaving Canada to go abroad or some other countries. Brain drainage, they call, right? Because of taxes. And now you realize that you are also on the same thing doing for your own self, giving money to government that you don't have to. How does that affect you, right? See how it turned around? This means money is just moving around for you. Now, why do we do this? There are three root causes that results costing us every year. And we're going to see next slide what those particular three causes are. But before we do, let's look at this particular number, 53%. That is your marginal tax rate that is charged on your accounts, specifically non-reg accounts, for holding asset in the wrong account. And that particular interest rate is working against you. Imagine half of your money is just gone because you are not knowledgeable about different investment that are available in different investment accounts. And that's specifically in Ontario for 200K income above. So can you imagine how much money you're just giving up? You're giving up half your salary because you don't understand the concept of what needs to go in which account. And this will affect Henry's the most because you're already paying high taxes. Now, on top of that, you're paying these taxes because of ignorance. And at Henry's level, especially if you're watching our channel, you cannot afford that mistakes. Inflation is already high, so let's not make our life more tough or miserable than it's supposed to be in Canada. So let's see what those three root causes are. First one, wrong asset in wrong accounts. These are interest bearing assets. You all must have heard about it or have an idea about it. GICs, guaranteed income certificates, bonds ETF, cash.to. This is specific ETF owned by Global X on TSX. And what they do is they go around, invest billions of dollars into different saving accounts held by a financial institution. Now you might be thinking, oh, I can do that myself. Why do I need these guys, right? But imagine they have billions of dollars behind them, so they can negotiate a better, higher interest rate than you can on individual level. And rough idea of how it works is this particular ETFs is currently the price is right now $50. So they invest that money that you put in, all of it every month. At the end of the month, let's assume the price went up from $50 to $50.15. So by the end of the month, they will give back 15 cents to all of their shareholders. The price reset back to $50. That's how it works. Sounds simple, right? But here's the twist. If you hold this particular investment into a non-rich accounts, 53 cents of tax on every dollar every single year, literally giving away half your income because you hold it in the wrong account. Correct? Second choice. And these are our root causes. Three reason your non-rich account is silently bleeding you dry every month, every year without you realizing it. First, you see how big this is because this particular situation can be completely avoided. Second, the Canadian dividend gross up trap. Are you aware of that or have you heard about it? If not, let's see what they are. CRA gross up eligible dividends by 38% before calculating taxes. This means whenever you have a dividend ETFs or dividend stocks, for example, VDY, most common dividend ETF, which invest in most of the big banks in Canada that gives out dividends every month. What CRA does is it grosses up that dividends 38%. Now you might be thinking, oh, this is good. That means I get more income, right? But remember, two sides of every coin, light and dark. If they're grossing up, they're increasing the income, they're putting you in a higher tax bracket. And what happens when you're in a higher tax bracket? You end up paying more taxes. You see, that's the idea of CRA. They're not doing this because they want to give you more money. They are doing it because they want to generate more money for themselves. Third, RSP first isn't strategy, it's default. As we started the episode, we are all told first you need to fill out your registered account. Like it's mandatory for everything. Doesn't matter what you are. Then only you think about other things, right? What happens is when you do that, especially at high levels or a high salary like you Henry's, You're blindly maxing your RSP, locking today's rate assumption. You're understanding what the future holds. And we're all aware AI is unpredictable right now. Anything can happen in AI. And so if you're locking in today's prediction, not knowing what's going to happen in the future, you are just ready to be slaughtered and gone, taken out in the financial sense, correct? Because you're making assumption right now for the future don't even know. That nobody knows. The creators of the AI don't know what is future holding. And you are thinking, because somebody has told us to do this strategy, let's do it regardless of our income, regardless of our situation, regardless of strategy, right? We just want to follow it like a herd. And then you know what happens to the herd, right? So now let's see what else do we have here. See how it disappeared? Because this is what happens in our mind when we do it. It disappears without us knowing about it. The compounding cost of each mistakes. You're going to see what the actual cost it happens to us when we do all these three mistakes in our life, in our financial situation. Before you look at that, look at the particular example. Room wasted 50%. This is going to start meaning a lot to you once you finish this slide. So let's see what the slides hold today. The real cost for you, Henry, financially. What the default is actually costing you. Interest income exposed every year. So as we discussed, if you put your GICs, your bonds, your cash.eto, cash.to, or any other ETF that generates interest income every month to you, you are just exposing yourself to interest income that are taxed at a higher rate and at your interest income. That is a problem which is costing you a lot of money in real time. And it's simply happening because every month income generated is given back to you. Think you made money. End of the year, you end up paying higher taxes, and the money is just nothing. It's gone because of that. RSP shelter room, use an asset you need it, right? So equity in RRSP, that's fine, correct? Why is that fine, you might ask? Because for most of the equity ETFs, you're not buying it to get dividends. You're buying it for capital appreciation, and you're buying it specifically to hold for a long term so you can sell out when you're ready to retire, correct? Now, what does that do? This means you only get taxed on it when you sell it. And if you're not aware, capital gain taxes on equity ETFs is 50%. Now, see how the number was? That means you only get 50% tax on it when you sell it eventually. Until it doesn't give you any interest, doesn't give you any dividends, it's just sitting there. And that's the advantage of holding this particular ETFs, which are equity ETFs, into a non-rich account rather than a registered account. Because, as you might be aware, RSP room, once you fill it, it's gone. It's not like a TFSA where you put the money in and realize, oh, you have made a mistake. Withdraw it next year and you get the room back. Once the money is gone in RSP, that room is gone forever. And remember, the room for RSP is finite every year. There's a reason for that. And so, if we're doing these mistakes of putting our equity ETFs in there, we are costing ourselves a financial mistake. Doesn't have to be. As we talked about, right? The third problem, the capital gain inclusion advantage. Executive VGRO. If you're not aware of these particular ETFs, executive specifically invest in what they called the world index. Now you might be thinking, world index sounds good. I'm in developed market, I'm emerging market, right? I'm in Canadian market, I am in US markets. That's what they sell it for. But you, Henry, are better than this. To look at the particular fun facts to see what the actual thing is. If you look particularly executive in this example, 25% is in Canada, 45% is in US. Now combine both of them. How much is it? Right? More than 50% is in just Canada and US. There's some amount which is left on emerging market and very few amount in developed markets. So you're basically investing just in North America itself. So it's not the world index, it is just the North American index. VGRO, same fundamentals. They have 80% equities and 20% bonds. Now you're thinking, oh, he just said you can put equity ETF as a non-registered account, right? That's cool. But it still have 20% bond, remember? And that will give you interest income that will be charged again at the full employment rate. So you see, this is confirmed in 2026 update. So sheltering that particular ETFs erases your room completely, and you are not taking advantage of the non-registered account is supposed to get built for this. That is the problem and the reason we need to be careful about this. But these are the real costs that will cost us a lot in a decade without us realizing it. In real dollars, the money you could have had to invest for yourself or to have a vacation, have an emergency fund, anything you want with that money, you're just giving it away to the government because you didn't know the real cost. So now I hope after seeing this particular slides and watching our show, you are aware of it, Henry, and you're planning to look at it as a strategy that works specifically for you and not against you. Now, the fix is required. No new money, just one rebalancing decision. There are four steps you're going to see next slide. Before that, look out something else. That is we started the show, right? 47K, the money you're giving up every year in a decade. And look at this. The RSP room gone, disappeared. You're paying 50% taxes on that. Imagine that thing. It's just gone. Now you might see something here. So let's see what they are. These are our action plan for today. As you always leave our audience with action plan, so they can actually look at the problems, understand the issues, and then try to fix it rather than just thinking about it forever. Here they are for this particular episode. Four moves, no new money. Start this week. Number one, move interest asset into RSP. As we talked about, this is what it means. So a GICs, a bond ETF, a cash TO belongs inside this shelter. So move it directly to RSP so you can get the interest income and it stays there without getting taxed. And then you can use it when you need in retirement at a lower tax rate. Number two, hold equity ETFs in non-reg account. So in our example, execute your VGRO long term, only 50% capital gain. Remember, only long term. If you hold it for less than 1 year, you're going to pay high taxes on that when you sell it. It's built for long term investors, not for short term traders. Very important fact to remember in a knowledge account. And also, if you just buy and sell in TFSA, they will consider this a non-registered account. They will get over the tax advantages. So you have to pay full interest on that, full tax on that. So make sure you don't do that mistake of buying and selling in TFSA. That's like a specific no for TFSA. That is not built for trading. That is built to ensure you have enough money so you can have yourself breathing room and money for retirement. So make sure you remember this, Henry. Do not do the mistake of trading in TFSA. It's going to cost you way too much than any money you can ever make. Third, pressure test your dividend holding, right? So do a pressure test, use AI to realize whether the dividend ETF that you're holding in your non-reg account, is it worth holding it over there? Or is it much better to hold it in a registered account like RSP or TFSA? Is the dividend grows up, they talked about 38%, worth the risk or the capital you're gaining, right? That's the thought. Number fourth, run your actual income profile. What does this means? This means if you have bonus, vesting equity, a potential business sale, your RS strategy will look different than the one that has a flat 200K income because your different room to negotiate, your different room strategy to move around are designed for you. So don't just blindly follow someone that has a flat income compared to you, which has a variable income, because those difference will actually cost you a lot of money. Not particularly in short term, you might not see it, but definitely in decade you will see the result of it. And that is just for being ignorant, especially in the world of AI. That is not acceptable. You need to know what is it. You have these channels, you have AIs, you have all the information you need, Henry. So now we need to act on it and see what works specifically for you, not for anybody else, specifically based on your situation. Now, if you want a tool that will help you out, to give you a starting point, I've discussed this tool before, which will give you a starting point to realize where you are, and then you can work from there. Here's a tool that I built for my audience. It's called Canadian Offer Intelligence Suite. What does it do? The free tool, so that means it will run your asset allocation math for exact situation. It will give you exactly how much the starting point is. If you do some evaluation, you can find out exactly what situation is, and then you can run your numbers and realize whether it is worth holding an investment in non-reg account or is holding an investment in registered account. That's all it is. The free tool made by me, privacy in mind, for our audience. And the best part about this is no sign up, 100% free, and it's built specifically for you, Henry's in mind, earning 150K to 300K, specifically in Canadian dollars. Because most of the tool that you might see might be in USD. It's specifically built for Canadian investment. So how to get it? Comment tool to get this tool today, right? If you want the tool, comment tool on the comment section, YouTube section, and then you get the tool. Simple. So don't guess. Run the actual math. Very important, because guessing at your stage is very dangerous. You're playing Russian roulette, which you don't have to. So don't do that, Henry. Be smart about your money. And then, if this change how you see your profile, subscribe and share with a fellow Henry that you know needs to learn this information. Channel name is, as you might know, Fine Print Canada, the fine print that shapes your financial life in Canada. Hi, welcome back, Henrys. For a closing, I have one question for you, just one. In your current profile, is your GICs, bonds, GIC ETFs sitting in non-registered account or registered account? That's it. Because that particular question and that difference is going to cost you a lot of money in long term that you don't have to. So that's my closing for today. Identify where those particular assets are and what you learned from today's episode. Whether good, whether bad, do your own research, but let us know what you think of today's episode. But answer one question for me: where are those assets sitting? And now do you know the advantage and disadvantage of each of them rather than following a blind blanket strategy? As always, it's Rahim from Fine Print Canada, Calm Finance, no hype, signing out. Like and share the video, subscribe to our channel, and we'll see you again next time. Same place, same time. Have a good one. Enjoy the Sunday morning.